Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing what is a preferred return. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com. A preferred return, often called PREF or the hurdle rate, is the minimum return that limited partners, passive investors, in a deal must receive before an investment manager or operator is able to earn a performance fee. Typically, preferred returns are between 6% and 9%, depending on the deal's risk. The preferred return is not a guaranteed payment, though. Performance fees help to best align the interests of the passive investor and the investment manager. If the manager does perform, they will be compensated. On the other hand, an investment manager will not partake in deals where they do not think they'll be able to substantially outperform the preferred return. This is better for all parties because you only want to be investing in deals with sizable upsides. Now, a couple preferred return examples would be if you invest into a deal with an 8% preferred return, and in year one, the investment manager returns only 6% in returns to you. In other words, there is a deficit of 2%. This 2% is accrued, and next year, the investment manager will add that 2% onto the 8% preferred return for year two. And this will continue until the preferred return is paid out completely. So if they were to fully catch up in year two, 10% would need to be paid out in year two. The operator must pay the preferred return before they are able to receive a performance fee. Some deals, like construction projects, will most likely not have any distributions until year 2 or 3, so that preferred return continues to accrue. A second example would be a deal that has an 8% preferred return and is an 80-20 split, 80% to the investor and 20% to the investment manager. And the deal begins to generate 13% returns. Well, a limited partner investor would receive their 8% preferred return and then 80% of the excess distribution above the preferred return. So 8% plus 4% or 12% in total they would receive. While the investment manager would take 20% of the distribution over 8% or 1% in this example. It is also important to note that the investment manager will most likely be paid other fees prior to receiving a performance fee. For example, they were most likely paid an acquisition fee when the property closed and are most likely receiving a monthly asset management fee. But these fees are really just covering expenses for the investment manager, their staff, office, travel, really just keeping the lights on. The operator makes a majority of their money on the performance fee, also known as the carry, their carried interest. It motivates the operator to deliver large returns to limited partners, exactly what you as a passive investor want the operator of the investment to be focused on, large returns, a true alignment of interest. This is why this fund structure of private equity and carried interest has worked successfully for several hundred years. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.